Hello friends, welcome to today's class. Voice is audible to you, all of you?
Yes, sir. Good evening, sir.
So today's class we are supposed to discuss about audit reports in the context of legal aspects of audit and accounts under Companies Act. Today our discussion topic is audit reports. Right, I'll go for screen sharing now. Just 20 minutes till I'm sharing the screen.
Yes, sir.
Hope it is visible now.
Yes, sir.
Yeah. So in this syllabus, in this aspect, legal aspects of the audit, and we are discussing that the chapter 10 of the Companies Act covers various things. These are the list of sections, right? Some of the sections, most of the sections we had covered in our earlier classes. Okay, there are some sections which deals with the audit report. The auditor has to sign the audit report. Okay, and when discussing about auditor's duty, we had discussed that is one of the duty of the auditor is to issue an audit report. Okay, so in that context, we will be discussing today about various types of audit report and what is the relevance of this audit report, why it is important for us to understand this audit. So, first of all, before coming to this types of audit report, let us first discuss about this auditing process. Okay. So now coming to that part, that how audit happens. Most of us must be knowing what is audit.
Sir, good evening, sir.
Very good evening. So we are just starting the subject. So before coming to that aspect, that importance of audit report, why audit report is important for us, we need to understand the concept of auditing first. Right. So we know that auditor's report is attached to the financial statement that I had shown you earlier. The financial statement, if you see, auditor must have signed as per our report of the event date attached. Auditor report is an attachment to the financial statement. Now, what do you think? Why it is necessary to attach a audit report to the financial statement? Financial statements, you know what are these financial statements, is it not? We had discussed earlier. Can any of you recall what are these financial statements? Quickly.
Sir, balance sheet, sir.
Balance sheet.
Profit and loss statement.
Yeah, statement of profit and loss. Next.
Receipt and payments. Receipt and payments.
No, receipt and payment is.
Oh, sir, cash flow statement.
Yeah, cash flow statement.
Cash flow statement, sir.
Cash flow statement.
Audit report on variance.
No, audit report is not a part of financial statement. It is an attachment to the financial statement.
No, sir, not
so
audit.
So far, you told me only
yes,
3
sir,
items.
Sir. 2 other reports are there, sir. Total 5.
Total 5 items. I had
yes, sir. There are total 5, sir.
5. One is balance sheet. Second is statement of profit and loss. Third one is cash flow statement. And 2 more. Who else can help me? Anybody else can tell me?
Or sir, I cannot tell you, but no.
Well, let me then reveal that thing. One is a statement of changes in equity, and other one is explanatory notes. These are the financial statements.
Yes, sir.
Okay. All these things are prepared by the management. It is a responsibility of the management of the company to prepare this financial statement. It is not the auditor's responsibility to prepare the financial statement. And again, management has to prepare in such a way that it shows the true and fair view. The financial statements must reflect true and fair view. How it will be reflecting true and fair view, that also we have discussed in the context of accounts when we are learning company accounts. Right? That means it has to be, the company must comply with the accounting standards and must be presented in the format which is provided in the Schedule 3 unless it is the company is exempted for that. Right. So in that framework, financial statements have been prepared, then it will show the true and fair. Auditors are asked to give an opinion whether actually these financial statements are showing true and fair view or not. So here one point is clear. It is not the auditor's responsibility to prepare the financial statement. It is always the responsibility of the management to prepare the financial statement so that it should give a true and fair view. Is it clear?
Yes, sir. Clear, sir.
Now, the question arises why it is necessary to attach the audit report to the financial statements. Please help me. Please deliberate why it is necessary to attach an audit report to the financial statement. Okay, management's responsibility, management has prepared. Then why there is a requirement
Sir,
to attach audit?
auditor, sir, for authenticity, sir.
Auditor?
Sir, it is statutory, this thing, sir.
Okay,
Statutory.
it is statutory requirement. Law
Compliance.
requires to do it. But what is the purpose behind that? Can any of you can guess? What is the purpose?
Oh, sir, to confirm that it is true and fair.
Yeah, to get it confirmed. Because auditor is an outsider. Auditor is an expert. Auditor is an expert in his subject. So it is an opinion. An opinion is called for from an outsider to give an expert opinion. An auditor is independent of the company. Auditor doesn't have any commercial relationship with the company. Is it done? So an independent opinion is asked for about the truth and fairness of the financial statements. Therefore, auditors' reports are attached so that the stakeholders, whoever is referring to the financial statement, he should also refer to the auditor's report to understand actually it is showing to a fair view or not. That is the purpose of audit, and that is where the importance of auditing lies. Okay. Now, and that is the purpose for which auditor issues an audit report. Or as per the law, it is a duty of the auditor to issue an audit. And it is also the duty of the auditor to follow a particular procedure. That means he has to comply with the auditing standards. That is also his duty. He has to give report in a particular manner, right? He has to present the report in a particular manner. He has to give the report to a particular person. All these things we need to understand. Okay, I think got a clear idea. Now coming to the process of auditing. Okay, can you guess what is the process of auditing? What exactly happens in the audit? We'll first discuss, we'll deliberate, then we'll go to the slides to understand that. Just give me some
Sir,
idea.
auditor will check. Sir, auditor will go through the actual statements prepared by the company.
So
And
most of the cases, all of you are associated with different kind of companies. You must be saying that auditors come and they'll be a kind of checking activities, right?
yes, sir.
But the question is,
Right,
or
sir.
you may also understand the concept here is that auditing is not exactly checking. Exactly, they are not checking.
So it's a verification or authentication?
It is a verification kind of thing. As you know, the purpose of that verification or the purpose of that checking is that with the help of that checking, they will be able to express an opinion. The ultimate objective is to give a report whether financial statements are showing true and fair view or not. Isn't it? That's the ultimate objective. But how they will be able to do it? So they follow some processes. Okay, let us discuss that process. What they normally do, the normal standard process is that auditor first of all tries to understand the business of the company. What are the activities that is carried out by the company? Auditor tries to understand. He tries to understand what kind of records are maintained by the organization. Then he develops an audit program. Keeping in view is that he has to give a report. And how he will ensure that in the report that where he is writing that the financial statement shows a true and fair view or doesn't show a true and fair view, what he is supposed to check. Accordingly, he draws a program that these are the things he has to do, he has to check. And for that checking means exactly what he is doing is applying some kind of audit techniques. Okay, some cases it might be vouching, he sees a voucher. Some cases it might be verification. He go for physical verifications, right? Or may do some other kind of verification. Some cases is ask for confirmation. Get if this balance confirmed from the debtors or get this balance confirmed from the bank. Some cases it goes for reconciliation. So vouching, verification, confirmation, external confirmation, reconciliation, right? Physical verification. These are some of the techniques auditors applies. All the techniques are applied. Sometimes he goes for ratio analysis. He calculates certain kind of ratios. Okay. So on that basis, he collects certain evidences through this verification, vouching. He collects certain evidences that actually these financial transactions or the financial balances are showing true and fair view or not. So let us company is showing this much of sales. So he verifies actually sales is there, they are not. He goes through the sales bills, sees the sales register, compares it with the GST returns, get it reconciled. Then he comes to a conclusion, okay, sales figure is okay. Similarly, what is the purchase? What are the assets? How these things are done? How these things are checked by applying various kind of techniques. So, he, you can say he conducts the audit. Got some idea? Okay, are you getting me? Are you getting me? Please reply, some of you.
Sir.
Sir, again, sir.
Yeah, please, you want to ask something? Please repeat. Okay, let me.
Sir, again, sir.
I want to repeat it. You want me to repeat it?
Yes, sir. Again, explain.
Okay. So I was explaining that what auditor does, auditor tries to understand the business of the organization, understand the records that are maintained by the organization, right? Then he applies certain audit procedures like vouching, verification, external confirmation, reconciliation, physical verifications, ratio analysis. So many techniques he applies, and through application of that technique, he collects some audit evidences. Right? Let us say he found that in these cases there are mistakes. So he collects certain evidences. On the basis of evidences, he forms an opinion. Right? He forms an opinion. Actually, the financial statements are showing true and fair view or not. And that opinion is communicated through an audit report. Okay. Now, have you understood now the process of auditing and how audit report is generated? So audit is a totally technically planned process. Auditor plans it and conducts audit by following that process. Are you getting me up to this?
Yes, yes, sir.
Yes,
Okay.
sir.
Okay. Now,
Okay, sir.
okay. Now, once he concluded, okay, finally I have collected all these evidences. Let us say he finds that out of 5,000 sales vouchers, he checked 2,000 are wrong. Then naturally he will draw a conclusion that sales doesn't show the true and fair view. Or he checked some assets and found that these are not physically available. Then he draws a conclusion on the basis of evidences that assets are not there. Or if he finds everything is correct, then okay, what the company is saying, financial statement shows the true and fair. Like this, he collects some evidences, and on that basis, he forms an opinion. And now, job is that opinion needs to be communicated to whom? To the owners. Owners are the shareholders. Once the auditing is over, he is supposed to communicate it to the owners of the organization through this audit. Okay, and therefore, to bring a kind of standardization, every auditor issues audit report in a standardized format. Okay, so on the basis of that format, on the basis of the opinion, we can classify the audit report into various types. You can say various types of audit. Now, I'm going to again going for screen sharing. We'll be understanding various types of audit. Okay, so are you able to see the screen now?
Yes, sir.
Okay. Now finally, auditor has to give his opinion. We can call it a kind of opinion called as unmodified opinion. That means it's a clean opinion. Auditor says the financial statement shows true and fair view. Or modified opinion. Here auditor says it is not showing true and fair view. And once it is modified opinion, it can be of qualified opinion, adverse opinion, or disclaimer of opinion. Okay. Qualified means financial statement showing true and fair view, but except in some situations. Maybe few situations are there where financial statement is not showing true and fair. Let us say particular item. Let us say financial statement is showing true and fair view except salary payment. Then auditor can issue a qualified opinion. It may say subject to subject to, let us say, salary expenditure of this thing, which is not reflected correctly in the books of account. Financial statement shows true and fair. That is why it is called qualification. The auditor attach a qualification to the financial statement. That means except few things, it shows true and fair. Okay. When auditor gives adverse report, when auditor clearly says that financial statement does not show true and fair view, on the basis of evidence, auditor comes to a conclusion that financial statement doesn't show true and fair. Third case is that a disclaimer of opinion. Suppose auditor is unable to collect sufficient evidences, or client doesn't cooperate, client doesn't give sufficient information, then auditor will not be in a position to express his opinion. So auditor disclaim. Auditor says, I am unable to express an opinion because of these reasons. Okay. So now we can classify it like unmodified opinion, qualified opinion, adverse opinion, or disclaimer of opinion. Okay. Understood?
Opinion, sir.
Yeah, please repeat your question. I'm unable to hear it. Any question you have? Please
Sir,
repeat.
what is qualified opinion, sir?
What is qualified opinion means? Auditor is writing that except some issues, financial statement is showing true and fair. That means by and large it is showing true and fair view, but there are some exceptions. With respect to some items, which is not affecting the entire financial statement, with respect to some items, it is not showing true and fair view. Otherwise, it is showing true and fair view. Okay. That is what we call it as a qualified opinion. Right? Understood?
Sir.
Let us say in the everything in the statement of profit and loss account is correct, but one particular provision has not been made. Suppose there is an expenditure which is to be incurred for which provision has not been made. So auditor can write, okay, except for the provisions of this much amount, except for the provisions of 5 lakh rupees which has not been created in the financial statement, the profit and loss statement shows true and fair. That means excluding that item, it shows true and fair. That is what we call it as qualified opinion. Understood? Okay, are you getting? Yeah.
Sir, qualified opinion with some very few requirements are there or very few irregularities.
Yeah, there are very few issues. There are very few issues. Then only I will be able to qualify the opinion. Okay.
Okay.
Understood?
Adverse means
Adverse means I am writing it does not show true and fair.
True and fair.
And
disclaimer means want of some records or want of some evidences.
Some reasons you are unable to give an opinion. Okay, I am doing one thing. At this stage, let me share with you one practical audit report. Then we'll enter into the topic. First, you see an audit report, how it looks like. Okay, should we do that? So I am
suppression of fact. It comes under.
That may be because of that thing, because of suppression of fact, opinion can be qualified, it can be adverse, it can be disclaimer. If one particular fact is suppressed and it will affect one particular item, I can give a qualified. Okay, but a fact is suppressed and it is affecting the financial statement in entirety. I may give a disclaimer or I may give an adverse. Okay.
Correct.
It depends. Okay. After some time, I will be sharing the practical audit report. First, we'll understand what is unmodified report. As I told you, that means this is so that financial statement has been properly prepared in accordance with the applicable reporting framework. That means the way the financial statement is supposed to be prepared is prepared in that manner, in that framework. That means accounting standards are followed, companies laws requirement, the formats, the schedule 3 formats, etc. is followed. If any other law, any other framework is applicable, they are complied with. If that is so, then unmodified opinion will be issued. Okay. And normally, the financial statements are prepared in accordance to a framework. We call it as the financial reporting framework. It has got some technique. It is a kind of technical jargon. It's a kind of jargon, the meaning of financial reporting framework. For our purpose, for our limited purpose, we'll understand. When I say financial reporting framework, we have to understand the laws, regulations, according to which the financial statement has to be prepared. Suppose Companies Act requires the financial statement has to be prepared in this particular format. So that's a part of financial reporting framework. If I want to report, I have to follow it. Right? Or accounting standards requires that these items should be disclosed. That's also a part of financial reporting framework. I have to follow it. Suppose your company is a listing agreement and your listing requirements requires certain kind of disclosures. So that's also a financial reporting framework. So all these financial statements has to be prepared according to the financial reporting framework. Right, and financial reporting framework ensures that the presentation is fair and all the rules and regulations are compliant. So we can say it can consist of a fair presentation framework or compliance framework. These things are little technical. I am skipping it. It may not be that important for us at our level. Okay, for professionals, these things are relevant. Just like for us, we'll be understanding that all financial statements are supposed to be prepared in accordance with the financial reporting framework, which includes the fair presentation framework and compliance framework. You may be thinking, what is that fair presentation framework or what is that compliance framework? Loosely speaking, we have to understand compliance framework. You have to understand that all the required things needs to be compliant. Fair presentation means you have to no doubt the things which are required to be compliant, that has to be compliant. But in addition to that, if required, for the purpose of fair presentations, one may disclose something beyond what is required. It's not required, but still you can disclose something beyond the requirement. We'll call this thing as the fair presentation framework, because the organization may feel that if I disclose something more, then only it will be presented fairly. So that is what we call it as the fair presentation framework. Okay, so these are some concepts, technical concept. We are skipping that thing, that technicalities. We have just understood what is unmodified report. Now coming to modified report. Modified report means auditors has to give either a qualified report or a adverse report or a disclaimer of opinion. This situation comes when auditor finds that the financial statements are not free from material misstatements. That means there is some kind of mistake is there in the financial statement. And maybe he is unable to obtain sufficient and appropriate audit evidence to ensure that it is free from material misstatement or not. So in that situation, auditor feels it is necessary for him to modify the report. And in that case, he can either issue a qualified report or adverse report or disclaimer of opinion. These are the three kinds of reports. So briefly, we will be understanding. And these reports, what are these kinds of reports when I am talking about? I am referring to standards on auditing. Right? These terms are there in the standards on auditing. These are basically technical literature. And for us, for MBA students, it may not be that relevant. Therefore, I am not entering deep into that. So these are the three kinds of reports will be issued if auditor decides to modify these opinion. Qualified, adverse, and disclaimer. When it is qualified opinion, when auditor has sufficient appropriate audit evidences that something is wrong, some misstatements are there, and these misstatements are material but not pervasive. Or not pervasive means it is not affecting the entire financial statement. There are some misstatements, but they are not affecting the entire financial statement. Auditor issues a qualified opinion. Okay. Adverse opinion, when auditors obtain sufficient audit evidences that there are misstatements, okay, and these misstatements are material and pervasive, and because of that thing, financial statement in entirety does not show true and fair view. So auditor gives an adverse report that financial statement does not show true and fair. And when auditor issues disclaimer of opinion, auditor is unable to obtain sufficient appropriate audit evidences. Okay, for some reason, auditor is unable to get this kind of audit evidences. Then auditor feels because of that thing, because of his inability or because of for some reason, but non-cooperation of the client, etc. He is not able to collect sufficient audit evidences, and the possible effect of this is that financial statement maybe is unable to express an opinion whether financial statement is clean or whether financial statement is, let us say, not showing true and fair view. Either it is showing true and fair view, whether it's not showing true and fair view, auditor is unable to draw a conclusion on that. In that case, auditor will give an opinion which is called as disclaimer of. Okay, now you see. Now, watch this picture, you'll be getting some clarity. When I say unmodified, unqualified report, that means it's a clean report. But some items are not clean. Auditor is unable to collect sufficient evidence that some item there is issues regarding to some item, then he will issue a qualified report. Here also some items, some audit issues are there, he can issue a qualified report. When adverse, financial statement does not show true and fair. When disclaimer, auditor is unable to collect sufficient appropriate audit evidence. So like this, different kind of audit reports can be issued. Okay, the auditor will find some audit issues or collect some evidences. If that audit issue is not material, then he will issue a clean report. But material, yet he got a material issue, but not pervasive. That it is not affecting the entire financial statement. Material, but not pervasive. Then he is an alloger. Alloger means it is a qualified report. Some issues are there. But material and pervasive, then either disclaimer or adverse. Adverse means it does not show true and fair view. Disclaimer means he is unable to draw a conclusion. Understood?
Sir, here unmodified, why it is written unqualified? Unmodified green means it is qualified.
Unmodified means it is not qualified. It is unqualified. Unmodified means unqualified. Qualified means, again, I'll show you that. Hold that. You see, when I say unmodified, it is unqualified. When it is modified, it may be qualified, adverse, or disclaimer.
Oh, unmodified means unqualified.
Unqualified.
It
No
is
qualification,
disqualified.
everything is clean.
Everything is clean, sir.
Everything is clean. When it is clean report, it is a, you can say it is a unmodified report or unqualified. Okay. Now, when auditor will think to issue a qualified report or adverse report, the auditor found some point. Let us say one point there is a mistake. Right? Everything is correct. Let us say a particular expenses is wrong. So here auditor has to decide whether he is a qualified or adverse. If that item affects the entire financial statement, we will call it as a pervasive. Then what he will do? Entire financial statement, then he will give an adverse report. But it doesn't affect the entire financial statement, affects only some item. He will issue a qualified. Okay. Similarly, again he will find if there is a confusion between qualified or disclaimer, you have to see that what the audit issue is material but not pervasive, then qualified opinion. But material and pervasive, then disclaimer. Okay, this is how auditor has to decide in which situation, which kind of report is to be issued.
Sir, audit issue and financial statement issue, two different issues, sir. Financial statement issue and audit issue.
Audit issues and financial statement, yeah, they are two different kind of things.
Financial statements that go on, so that cash flow and balance sheet and
Some issues related to that. And audit issues, that means regarding auditor's collection of evidences. Auditor is unable to collect some evidences, but which is material but not pervasive, then qualified. But material but pervasive, disclaimer. So this is relating to audit issue. This is relating to financial statements issue.
Sir.
Okay. Now, friends, quickly, I will be covering this part. Basis of qualification paragraph. Here, one thing we have to understand: when auditor is qualifying his report or giving a kind of adverse report, he has to write the basis, that is reason for which he is qualified. Okay, auditor must specify the reasons of his qualification. This is the requirement of the standards, right? When he is giving a qualified opinion or adverse opinion or disclaimer opinion, he has to give the reason. For clean report, no reason is required. Okay, reason has to be mentioned. I will be quickly showing you a practical audit report. You will be able to understand in which situation auditor has to give a reason for that. This thing, what I told you, in which situation auditor has to issue a qualified report, which situation this auditor has to modify his report, which situation he has to give adverse report. The same thing is explained in the chart. You can see it later on. Sometimes what happens, auditor has got some other reporting responsibilities. Like maybe auditor has to require about regulatory framework, or maybe in certain times government orders that some other things also has to be reported in addition to the normal audit report. So auditor has to discharge that responsibilities also. Okay, report on legal and regulatory framework. I will show you one audit report where these things are also to be reported. So auditor has got some additional responsibilities also for certain class of companies that also needs to be discharged. Sometimes auditor attaches one more paragraph in the audit report, which is called as the EOM or emphasis of matter paragraph. What is this? If auditor want to highlight something, bring it to the attention of the readers of the financial statement or readers of the audit report. Auditor feels something is important, which needs to be drawn to the attention of the users. The auditor may write one paragraph without qualifying. It's not a qualification. Auditor want to emphasize something. He can write it in the audit report under the heading emphasis of matter paragraph. Okay, something related to the financial statement. Some item is there in the financial statement. Auditor wants to emphasize that thing. Then he has to give it writing under EOM paragraph. Okay, so what is the requirement of this emphasis of paragraph? You must be able to guess it. You can read it later on. Here, objective is that without qualifying anything, auditor wants it to draw attention of the users. Then emphasis of matter paragraph can be added. And there can be one paragraph that is called as the CAM paragraph or key audit matters. Here also, auditor feels that there are certain matters which as per his professional judgment, he feels this is significant. He wants to highlight that which affects his audit. Certain issues are there which has affected his audit, which is of significance. He can write that thing under the key audit matter paragraph. Then any other matter also auditor wants to disclose, then he can write one more paragraph like other matter paragraph. There he can also write it. Okay. And finally, auditor has to sign the audit. Okay. Now here what I'll do, before this thing, I'll be sharing you with one more screen. I'll be able to, I'm trying to show you a practical audit report quickly. You see how audit report looks like. You see this is a particular company's audit report. Are you able to see it? You see, audit report has got a title just like independent audit report. It has got an address. It is addressed to the members. It has a report's title, report on the audit of the standalone financial statement. Here it is a qualified opinion. Auditor writes that we have audited the financial statement of this company. Auditor has to identify the company, identify the financial statement like balance sheet, as on this thing, profit and loss statement, cash flow statement, all these things auditor has to write. You see, auditor has qualified. Okay. Auditor has qualified. What is his qualification? As you know, basis of qualification has to be there. Auditor has written basis of qualification. Fixed asset register does not have full particular, that is his qualification. CSR activities, maybe company has not complied with Companies Act, that is his qualification. Like some qualifications are added. All these are qualifications. You see 5 qualifications auditors are added. That means subject to this thing, it shows true and fair. Okay, these are some audit issues. It shows that. Then you see emphasis of matter paragraph. Under this, auditor wants to emphasize certain issues. Auditor says that we are not qualifying your financial statement. Is writing our opinion is not modified with respect of these matters, but still we want to emphasize. Then auditor writes it under this paragraph, emphasis of matter paragraph. Then you see information other than financial statements of auditors thereon. Okay, some other information auditor adding here. Then again, key audit matters, something auditor is writing, which is relevant for which is significant for the process of auditing. Auditor writes that maybe books of accounts are not maintained up to the mark, internal controls may not be adequate. Auditor writes it under the key audit matters for it. Then auditor also writes that it is the responsibility of the management. What is the responsibility of the management, like preparation of the financial statement, that also auditors write. Okay, what is auditor's responsibility? Auditors writes it. auditors adds one more paragraph that is called as other matters. And we are discussing there might be requirement to report for under other legal and regulatory requirements. And here in this case, under CARO, this is a order from the central government, company's auditor report order. And central government has asked the auditor to report certain thing under this CARO order. At that time, it is CARO order 2016. Now it is CARO order 2020 has come. So accordingly, auditor has replied to that order. What is the requirement of that order? Auditor has replied. This is as per central government's order, auditor is replying some additional things. Finally, auditor has signed his report. Then there is one annexure. Okay, this is according to some specific requirements. It is annexure A. If you see the audit report, what is annexure A? It will be clear here. What is annexure A? Annexure A is that what is the requirement of CARO? That is what the central government requires. That has been reported in annexure A. What is annexure B? This is a government company, so C&AG has given some specific direction that is reported in annexure B. Okay. And what is annexure C? It is a report on the internal financial controls. So all these items are you see in the audit report. You see this is the full document. This is as per CARO report. What central government has asked, this has been reported.
So what is CARO, sir? Full form?
Company's audit report order. So central government has passed an order. Accordingly, it has been presented. You see, this is the supplementary order issued by C&AG. Accordingly, auditor has prepared this. CARO report you can download from the net. CARO order you can understand. Auditor has to. So finally, last part of the audit report is that this is a report on the internal financial controls. All these things auditor has to do. Okay, CARO report I am having, but I am not sharing it for the want of time. You can see it just now. CARO report, CARO order is like this. Central government has asked to certain companies to report. Accordingly, this company has reported. Okay, you can see it later on. So here we'll stop. We'll conclude.